This is Mark with Semantics Trading with your daily report. Today we had a strong rally into the close as the market looked highly optimistic about the future. Do note that every large rally into FOMC had led to a large reversal in the past, the following day, but I think what is very important is the GDP number tomorrow, which will be very, very key as it will determine whether or not this is just merely another bear market rally or something that could be a start of something new. There are two possible scenarios for tomorrow, which I want to highlight when the GDP number is announced. If the GDP number prints negative, and that would likely cause a yield curve to steepen, as it shows that the market is now looking for future recovery. Of course, this is out of the question if inflation remains high and recession deepens dramatically. And we do see potential rate cuts going into next year, which the markets have already priced in. If there is a positive GDP number print, then the yield curve will probably further invert, since on the longer end you are sucking it out the growth premium, and the shorter end of the curve moves higher as the Fed has room to be more aggressive. The yield curve did steepen a bit today, and perhaps a negative print tomorrow can lead to further steepening. It appears that we may be at peak rate hike fears and peak growth and inflation fears, and we can see this in the year-to-date underperformance of cyclicals versus defensive sectors, and it appears that the market is taking risk on at the current moment. During a press conference, Powell removed forward guidance and said not to expect rate cuts next year as well, and the yield curve, however, has steepened, which is showing a more dovish Fed. Also, Jeffrey Gundlach says if we're able to get the inflation rate down significantly, we can avoid a significant recession and perhaps only see a mild recession. This is due to the fact that the labor market is still very tight, as there's a lot of vacancies, and despite that we have some uptick in jobless claims, overall the picture remains very, very strong and robust. Also on Friday, the PCE number is very important, as that is what the Fed uses as a measure of inflation, and that is their main focus. The market is overall a bit less short. We are seeing equity position overall tick a bit higher, but there is still some room to go if we have some more risk taking. As you can see, we're still at very depressed levels. The overall positioning across many different fund strategies remains very depressed, and if we continue to see strength in the market, perhaps it can influence some of these funds to enter on the long side and participate, and that will in itself bring stability to the market, and then perhaps the market will be able to find its footing. But of course, this is just a what if scenario. Liquidity still remains very abysmal, which means that there is not much participation going on, and low liquidity can lead to insane moves. As you can see, we had a 4.5% rally on a NASDAQ, so it goes both ways. And we did close above the 4,000 level on the S&P, which is a very important level in terms of options positioning, as we highlighted in the previous report yesterday. And if you take a look at VIX, it did close above the most recent lows, but if we look at the volatility of VIX, or VVIX, we are seeing VVIX continuing to move lower, and it is closing at the lowest levels since July of 2019. So this is quite notable, of course. And going on with the housing data that came out today, we do see escalating mortgage rates and housing prices continuing to impact potential buyers. Pending sales fell across all four major regions in June. And even if we do see the equities market recover, I do believe the housing market will still remain weak for a bit longer. And the pending home sales index, which is essentially a forward-looking indicator of home sales based off contract signings, dropped 8.6% to 91 in June. And we did see also durable goods did surprise to the upside today, which looks good, but it is largely driven by defense and aircraft parts as a result of the Ukraine war. And Meta, which is one of the big tech companies, reported today after the bell, and it is down quite a bit after hours due to a miss under guidance and saw revenues fall for the first time in ever. Although I would say Meta is a massively undervalued company if you look at it from intrinsic value, if you were to do a discounted cash flow, of course. And oil continues to bid higher as the supply side issue remains unresolved, as we have highlighted in the past that we were bullish oil, and actually some of our traders have taken a bullish position on oil. And as the supply side remains unresolved with the U.S. strategic petroleum reserve is draining to new lows, and the refiners are running at max capacity, which is, well, it's unsustainable. And also, it only takes a really bad blackout or flood or storm to really cause a huge uptick in oil. The demand for energy shown by the recent report has also surpassed the pre-pandemic levels in 2019 at the same time of the year, and it is set to grow at a more rapid pace in the future. So it does not really bode well for this oil issue that we are facing. And with that being said, that is it for today's report. I want to thank you all for watching. And if you did like the video, be sure to like and subscribe. And be sure to check out our Twitter, social media pages, as well as our Discord if you are interested in a live commentary. And with that being said, I want to thank you all for watching. This is Mark signing out.